And as luck would have it, we have a repeat call from Frank that plays right into some of the things that we'd like to talk about. So why don't we, Brent, answer Frank's question and then take it a little further and deeper into the topic at large.
Sounds great.
Hey, guys. This is Frank, Grand Rapids. I left a message earlier, and you had answered some of those questions on the last weekend show about planning for income in my retirement. But I do have one more question. Some of the shows I listen to on the radio and even on television at times, they talk about allocating growth stock mutual funds across various sectors and having the ability to take 8 to 10% off to live on during retirement. That's a little different than what I've heard you guys talk about. If you can, give me your thoughts on this. Appreciate it. Thanks.
Well, first of all, just as a quick reminder, you can also get your calls answered at 24/7 hotline, at the 24/7 hotline for Financial HQ, which is 888-888-9572. That's 888-888-9572. You can also pose questions at the website, financialhq.com. Well, the first thing I'll comment on, and then I'll turn it over to you, Brent,
Sure.
is whoever Frank was listening to on air that told him that he could live off of 8 to 10% withdrawals on his retirement plan, they should take the microphone away.
That's right.
There is no way in this world, under these environments, that you can anticipate 8 to 10% withdrawing out of a retirement plan to actually make it through retirement.
You're right, Mike. Even back in the 80s and 90s when the market was on one of its greatest runs of all time, even at that point you would hear at most a 6 or 7% withdrawal rate mentioned as reasonably sound advice, but even then it was no guarantee. Depending on your mixture of investments, that your assets would last as long as you did at that rate. So given the economic times in the market we've experienced in the last 10 to 12 years, most experts have way dialed down the safe ratio of withdrawals. And Frank's question leads to a great topic that we wanted to touch on today, and that is excess withdrawal risk. Of these 12 different retirement risks we're working our way through, excess withdrawal risk is a significant one. And it simply states that you might be withdrawing more out of your portfolio than your portfolio can handle, especially given the sequence of return risk that you and Mark touched on last week. That also has an impact. So what it really boils down to is what kind of systematic withdrawals can one take if they're looking to try to make their nest egg last as long as it can.
And just to interject for a moment, this is essentially a mathematical equation.
Right.
You're essentially calculating out what are the odds of certain things happening. So it doesn't mean that you can't have a really nice return in your portfolio over a given year or two. It's just the fact that you also have to be rational about the idea that a crisis could happen or that we could have a bear market during some of these years and so on. So it's kind of an odds calculation.
You're right, and we are going to touch on that because a lot of the industry experts use what's called Monte Carlo simulations to help a person determine what would be the likelihood of their money lasting based on certain withdrawal rates and rates of return. But we all know what Monte Carlo is known for, right, Mike?
We do. That's a gambling term.
That is a gambling term. So hence the reason that it's not guaranteed. So we need to be careful there. But Mike, at its basic core, systematic withdrawals, as taught to most investors, simply says that you build up a nest egg, you've saved that nest egg and worked for it for your working years in your life, and now it's time to make withdrawals off of it and use that to supplement your income with Social Security, required minimum distributions from qualified plans like IRAs and things of that sort. On the surface,
defined benefit plans.
Yep. On the surface, it sounds like a pretty safe, simple strategy, and it is simple, but it's inherent with some problems. Number one is that strategy pretty much tells you that you're going to be pulling off earnings, so interest, dividends, gains. Most of the time, depending on what you're investing in, those are going to be taxable interest, earnings, gains. So right from the get-go, the strategy is a little bit faulty because you are dipping into taxable interest and yield first. That also can have effect on your other assets, so your Social Security with income as an example, because those interest and dividends do count in determining if your Social Security benefits are taxed.
Right, because they're looking at your income to identify whether your Social Security benefits are taxed, and that those dollars you were just referring to goes into the income equation.
That's right. So it immediately creates some tax struggles for people. A better way to think about it is to use some kind of a laddering strategy or a bucket strategy or a pockets of money strategy like you touched on in the last segment. In other words, to divvy your assets up into different types of accounts when you can, using tax-advantaged accounts to try to mitigate the tax problem that we just touched on. But these Monte Carlo simulations, Mike, are a little bit misleading at times and can be a little bit faulty. I've got a chart here that kind of shows different mixes, kind of a stock bond mix. In this example, we're just looking at the S&P 500 index and then a bond index and kind of a combination of the two. And what does that look like? So just as a quick example, at a 8% withdrawal rate, which is what Frank mentioned on that call, even at a 50-50 mix, your odds, in other words, the Monte Carlo simulation tells you that your odds of continuing to have assets after a 30-year period, inflation adjusted, is only 15%. So when you start taking significant withdrawals off an account, your odds start to dramatically decline. So if you use the same 50-50 mix and only use, say, a 4% withdrawal rate, your odds, again, not a guarantee, your odds go from 15% to 88%, so significant.
So when Frank referenced that he heard on some other show that you could pull 8 to 10%, so at 8% with a 50-50 bond equity mix, you're looking at 15% probability that that's going to last. If he's pulling 10%, the probability is probably zero. I mean, our chart doesn't even go that high.
It doesn't go there.
So what we've been talking about here on Financial HQ is some of the very core and important retirement risks. We're getting into excess withdrawal risks. We had a call from a friend named Frank who enjoys listening to the show and actually gave us a follow-up call about trying to figure out how much money he can pull out of his retirement plan. And Brent, you've been discussing what that means in terms of excess withdrawal risk and some of the mixtures here. Maybe just before we move on, if you could touch quickly on what happens if they're in all equity or in all bonds.
Oh, sure, Mike. The ratio start to shift there as well. So the more you go into an all equity scenario or an all bond scenario, your odds or probability of success also decline. Then if you couple that with a higher increased withdrawal rate, the odds go down even more significantly. So I mean, the two most dangerous things you can do is to have an extremely high withdrawal rate. 6, 7, 8% is just not a sound strategy right now. And then if you get dramatically swayed or invested into one particular category or another, it's also very risky. Mike, I have a little example here, real life case that I'd like to quick run through to show somebody how this can work, because people always ask us, well, then what do I do?
Yeah. What's the solution?
What is the solution? So here's an example of an individual, 65-year-old, who has a $1 million portfolio, and they are going to invest it equally in equities and bonds. The chance of them still having money by the age of 92 is about a 76% probability. Again, not a guarantee, just a probability.
And that's pulling what percent?
That would simply be pulling 4%.
Okay.
Which again is fairly conservative, but even in today's market, not sure that that should be used either. But by simply shifting, Mike, a little bit of the assets, in this example, a third of the $1 million portfolio into a guaranteed income annuity product, and then mixing the rest between equities and bonds equally, their ratio or their odds of success go from 76% up to 87%.
Well, one of the other cool things about that, Brent, is by using that income annuity, they're able to get the advantage of some basis as well.
Correct.
Because now the income coming out of that, the basis gets spread over that income stream, whereas, as you pointed out a few minutes ago, generally when people are pulling out of their other accounts, they're pulling the taxable portions first.
Yeah. Using an income annuity, you're getting partially return of principal, which is not taxed again. So it definitely reduces the taxes. The other benefit that this type of investment or product does for people, Mike, is it gives them time to let the markets do what they do. When you're depending upon the market month to month, year to year for your paycheck, that's pretty scary. But when you've got a guaranteed income stream coming in to help supplement your Social Security and other things, and if you do that for, say, 5, 10, 15 years, your odds of success go up because you're giving the market time to do what it does and time to grow those other assets for you. So there's tax advantage reasons to do it that way, some laddering of your assets, but also it dramatically helps in the probability of success.
And if you're trying to tackle issues like this, I would encourage you to take advantage of the Financial HQ Network Advisors. You can set an appointment with these people all across the country by dialing our 24/7 hotline at 888 888-9572. Just leave your request and we'll get back to you. Also, I think the reports that you mentioned previously are very pertinent to this discussion as well. So if you'd like to get access to these reports online at financialhq.com, you can download the Taxpayer Awareness Guide. You can also download the free report titled, Are Your Assets Diversified with Taxes in Mind?